hate to be the bearer of bad news, but we are headed into potentially the worst recession since we've seen since the early 80s. Today I'm going to share with you not only a very accurate way to predict if we are going to hit a recession, but also why. Now, this is not financial advice, but a lot of you are asking questions like, should I continue to invest and should I buy the dip? Well, stick around to the end of this video and you'll have the answer. This method will show you if it's time to continue to stick money under the mattress or if it's time to start actually investing again. This method comes directly from the Federal Reserve of San Francisco in an obscure economic letter written almost 5 years ago. In fact, this method has predicted with eerie accuracy the recessions that have come up over the past 60 years, what's known as the inverted yield curve on US Treasury notes. A Treasury note is US government debt security with a fixed interest rate and a maturity date typically between 2 and 10 years. Basically US debt. Pretty simple so far, right? Well, to explain it another way, see, the US government offers fixed income securities to consumers and investors to fund its operations. That includes Treasury bonds, Treasury notes, and Treasury bills. Treasuries are debt instruments which investors like you and me effectively are lending the US government to purchase the amount of the bond. In return, investors like you and me are paid interest or a rate of return. When the bond market matures, investors are paid the face value of the bond. Usually, the longer the term of a Treasury note, the greater the risk. Therefore, it pays out a higher yield or interest rate. And the opposite is true. The shorter the term on these treasuries, the less the risk and the lower the yield. An inverted yield curve is a signal that investors are more concerned about the immediate future than the longer term. This forces interest rates to move higher on short-term bonds than it does on long-term bonds. So this chart shows how a normal curve would look. The simple logic here is that it's riskier for you to buy a longer-term bond and you are rewarded proportionally for taking a larger risk. So for example, you would get a significantly lower interest rate if you were investing for 1 year versus 20 year, as it's generally riskier to stash away your money for a longer time period. But the yield curve is not always positive. If the long-term and short-term rates get closer together, the yield curve becomes flat. Finally, if the short-term rates are higher than the long-term rates, the yield curve becomes inverted. The yield curve becomes inverted when a lot of people are worried about the short-term economy. In theory, you would demand a higher return for taking on higher risk. So if the yield rate for a short-term bond is higher than a longer-term bond, it implies that investors are so worried about the short-term economic outlook that they are willing to invest in a long-term bond at a lower rate. Are you still with me? And as you're about to see, the term spread, which is the difference between the long-term and short-term interest rates, is a strikingly accurate predictor of future economic activity. Every US recession in the past 60 years was preceded by a negative term spread, that is, an inverted yield curve. And furthermore, a negative term spread was always followed by an economic slowdown, and except for one time, by a recession. So Treasury notes are basically a loan to the US government and are generally seen as a safe bet because investors think that there's little risk that the loan won't be paid back. These government bonds have seen a flood of interest in recent weeks amid geopolitical uncertainty and tightening financial conditions. The Federal Reserve said last week that it's considering as many as 6 more rate hikes in 2022 alone. So that's making investors lose their appetite for stocks and more volatile assets and turning to more dependable investments like treasuries. But here's the catch. As more people are rushing to buy bonds, which causes the yield or the interest rate to fall, which ends up making it less attractive an investment. So let me break this down for you. I'm about to share some notes here. As I said, the inverted yield curve is really a warning signal with an eerily accurate track record for predicting future recessions. And as I said, the shape of this yield curve, which plots the return of Treasury securities, is one of the most reliable indicators of health in the economy, and it's really been flashing signs of a looming recession, which we'll see in a second. Okay, so a quick recap here. A 10-year Treasury note typically delivers a higher rate of return than shorter-term notes since an investor's money is committed for longer. Shorter duration Treasury notes, such as a 2-year or 3-year bond, generally offer lower yields or lower interest rates because risks are more predictable than over a longer time horizon. But when the return of a 10-year note is lower than the 2-year, that indicates a pessimistic outlook on the part of investors and a reluctance to commit their money. And yields are heading in that direction. The spread between the 10-year Treasury note and the 2-year note currently sits around 0.33% compared to around 1.5% a year ago. A yield curve inversion has predicted every single recession since 1955, according to research from the Federal Reserve Bank of San Francisco and that obscure economic paper I shared with you just earlier. Okay, so don't panic. An inversion doesn't mean that stocks are about to go into a meltdown. While an inversion generally signals that a recession is coming within the next 12 months, sometimes it can actually take years. For example, the curve inverted back in 2005, but the Great Recession didn't start until 2007. And the most recent version in 2019 prompted fears of recession. However, it actually materialized in 2020, but that was mainly due to the COVID pandemic. So as I mentioned, don't panic, weather the storm, it's gonna get better. Subscribe to my channel and be sure to watch this next video on a stock picking strategy that beats the market every single time.